Hi everyone, welcome to Quantsapp and welcome back to yet another video. In this video, we will learn about selling strategies wherein what is a short put, what is a short call, how can you go ahead and write options in a much more better and much more efficient way, something what we will learn in today's video. So do check out the video till the very end. So to start off directly, let's understand what a short put will look like. Okay, how the payoff will of a short put will look. Okay, and when you should create a short put. So I'm going to architect. So you can use these tools, architect, something like architect on our application, which is web.concept.com is the link. You can access this app on web, Android and iOS. So coming back, let's say I have a view on the market. I have a view on the Nifty. That Nifty, it may not fall from this level. Okay. But goes up or not, that is completely a different story. I am feeling that the market might not at least fall from the current level. Okay, is what my forecast is. So in such type of conditions, if you buy a call option, right, what you are expecting, you are not expecting a breakout, right? There is a difference between a breakout and the instrument remaining where it is. A breakout means that you are expecting the market to go up, right? It is at 17,800 now. You are expecting it to go to 18,000. That is a clean textbook breakout. Maybe if not 18,000, maybe 18,500. That is what a breakout will mean. But what I am expecting is that market right now is at 17,800. So it will spend some time somewhere around 17,800, and then it might move upwards in slow and steady manner. But not I'm not expecting a very fast move to come in. I'm expecting a very slow move to happen in the upwards direction. So if I buy a call option, the problem is the theta, the time which is decaying my option premium. So in such type of instances, what is that instance? What is that condition? That condition is that you're not expecting the instrument to fall from here. Number one. Number two, you're expecting that the instrument will go up in a slowly and steady manner. Okay, that is what your forecast is. Okay, so it is called as bullish to neutral. When your forecast on the underlying is bullish to neutral, that is the time this strategy would be more lucrative. Okay, over here again the payoff which is generated, that is bullish. So the black line on the graph is showing us T plus NPNL. Now let's say I want to see what will this strategy, how will this strategy look like if I hold this for 4 days. Then I can do that. If I want to see how much it will fare me if I hold it for 7 days, then it will show me on what various levels of market, how much profit or loss I would make. This is of short put. Okay. And over here, whenever you are writing options, you enter in an obligation. So over here, the obligation is to buy the underlying shares at the predetermined price, which is the strike price. Okay. So what is the summary of short put? We will deploy short put in bullish to neutral market conditions. Okay. Second strategy is short call. Okay. So it's completely opposite is what you can call it. So let's say the monthly expiry. Okay. Again, when you're expecting that the instrument might not go up from here, it might not go positive from here, that is the time you will create a strategy, something like a short call. Okay. And it is completely opposite. So it is basically bearish to neutral. Whenever your forecast on the underlying is that whenever you are feeling that the instrument might remain bearish to neutral, this is the strategy what you can start to observe. Now the problem with these strategies is such that these strategies, they come with a problem which is undefined loss. So over here you can enter in this strategy, but the problem is the undefined loss that you might make if something goes against you. So let's say you forecasted that Nifty might remain bearish to neutral, and the moment you initiate this strategy, the market starts to collapse. Then that these type of strategies, they become a big problem. So for that, be it a short put or be it a short call, what you can do is you can go ahead and hedge this strategy. Okay, you can go ahead and hedge this strategy by buying a out of the money call option. Okay, so in this scenario, what I will do is I will go ahead and buy a 18,100 strike price call option, or maybe even far off. Okay, maybe even far off, and I will convert this strategy into a bear call spread. Now what will happen in this type of strategy? So bear call spread is a vertical spread wherein what you are doing is you are basically selling a call option, plus you are buying a way far OTM option as well to hedge that, to protect yourself from undefined loss. In this strategy, you'll make a loss, okay, which is okay, but you will not make a undefined loss. But still, this strategy, if you just check this out, okay, still this strategy is a theta positive strategy. So over here, what I'm looking at is the theta, okay, so it is the positional theta. It is showing us that this entire strategy, like this combined strategy, if I hold it, it will still give me a profit 120 rupees roughly if I hold it for one more day, right? So the view remains intact, no undefined losses, plus you will get margin benefit as well, because the system will identify that the position that you have taken, that has been hedged, so you will not face an undefined loss, and also the margin will be reduced. So this is one thing what you can do. Now similarly for put, you have sold a put option, you will buy way far out of the money put option to hedge it and for to solve the same purpose ultimately. Now talking about non-directional things. So option writing has attracted many traders in recent times because of non-directional trading market going nowhere. So at that time, how does that benefit? So I'll just tell you. Let's say you sold the put option, okay, let's say at 100, okay, and you sold a call option, let's say at 100, okay. Let's understand it how it will look. And let's say there are 15 days left to expire, and the stock is, let's say, trading at 500, okay. 500 is the spot price when you sold at 100 rupees call and 100 rupees put, okay. Now let's say when there are 7 days left to expiry, means 7 days have passed away and the stock is still trading at 500, okay. But will this calls and puts will be trading at 100? The answer is no. Why? Because the theta will keep on decaying, and this premiums, maybe this premium might be somewhere around 70, this might be 65 or somewhere, or vice versa, right? So the premium will decay from this particular entire strategy, right? So that is the reason what do people do is they sell call option, right, and also they sell a put option. If the market remains within that range, okay, the premiums that they have received, if the market remains in that range, they will start making a profit. So now how will that strategy will look like? So if I just go to architect, custom strategy, okay, so let's say sell, okay, add like, okay, so let's say 17,700 put sell. Okay, so now call sell, put sell, it will give us a neutral payoff, right? You are offsetting everything. See now if the market remains within this range, which is expiry break even and expiry break even too. Okay. If the market remains within this range, you will end up making profit. Again, the problem is that if the market goes on either of the side, if the market goes negative or if the market goes positive, still you will end up making an undefined loss in this particular scenario. So what you can do is you can convert such type of strategies wherein when you're not ready to take an undefined loss, you can convert these type of strategies into iron flies. Okay, what is an iron fly? Iron fly is nothing but you will go and buy out of the money call option, which will hedge your call side, but you also need to hedge your put as well, right? So what you'll do is you will buy a put option as well, and that will keep you sorted wherein you will not face an undefined loss in this particular strategy. So at the top, if the market remains exactly where it is, 6,900 is profit. If the market goes on either of the sides on their wings, it will make you a loss of 7,300. And apart from that, I would like to invite all of you to Option Symposium 5.0, right, which is an iconic event, okay, which will happen at the Bombay Stock Exchange, and it is India's largest option trading conference, wherein a lot of people, okay, a lot of traders who have aged in options trading, they will guide you through, okay, they will guide you through with their actionable strategies, and also there would be a panel discussion, and the entire idea of the panel discussion is going to be learning and hacks and tactics to trade options much more better. So 11th and 12th February is the date, so don't miss out on that. It will happen at the iconic Bombay Stock Exchange, so never miss out on such opportunities because they will come maybe once a year, right? So don't miss out on this. So do check out Option Symposium. There are very few days and very few seats left, so check out the link in the I button. And to summarize, so today's video was more on the basic front of options trading, wherein why to write options, right? And how to write options is something for beginners specifically is covered, right? So I would recommend from my end, hedge it, right? Don't randomly sell call options and put options just because it looks very easy, but hedge it so that you will make a loss, but that would be very small amount. So you will not lose a big chunk of your portfolio to that. And yes, folks, that was it from my side. Thank you so much for staying tuned along with me up till here. If you have liked the video, do hit the like button and do hit the subscribe button. Thank you. Bye bye and take care.